So good morning, Nicholas. Thank you very much for doing this.
Good morning,
We're
James.
going to be talking about Henderson Diversified Income.
Yes.
Which, so if we go to the first slide of those.
Right. So,
just tell us a little bit about the trust and what it's trying to achieve, please.
okay, will do. So this is a fund that we launched back in 2007. And what the fund is trying to do is to provide a high level of income to its shareholders with the additional objective of capital growth over the long term. We launched this to give shareholders a vehicle which dynamically asset allocates between floating rate and fixed rate bonds. I'll show you the allocation on the next slide. But what we do, what we're trying to do is we're seeking to deliver a quoted dividend that we feel is sensible and sustainable. We don't want to surprise shareholders in this vehicle. So on this slide here, currently it has net assets of £173 million. We use both physical and synthetic gearing on the trust, as you can see on the table in the left, to enhance returns and deliver that high income to our shareholders.
You better explain what synthetic gearing is, if you don't mind, please, Nicholas.
Yes, I will do. So the synthetic gearing is we can go long something called iTrack crossover, which is basically an insurance contract on a basket of credits. So this gives us exposure to the underlying credits. So if we're feeling bullish, we can sell protection. So we're in effect selling insurance on the credits and hopefully clipping the coupons and the premiums to the benefit of the shareholders. But in our view, we think that leveraging up high quality bonds and making a turn on being able to borrow at cheaper rates makes sense for our shareholders. So essentially, this is a geared credit fund holding a mixture of floating rate and fixed rate bonds. As at the date of this slide, we held at 5.1% in loans. We've recently been increasing that exposure in the last few months as we've found some interesting opportunities in the loan market. We move to the next slide, please. So what differentiates us from other bond fund managers, in our opinion, is we buy quality bonds and we use filters to do that. So what does that mean? So first of all, we are developed world only, so we exclude all emerging market countries from the portfolio. We also screen out industries like airlines and energy that we don't like. We call our approach sensible income. And historically, these types of industries are very cyclical, and they also don't generate very good return on equity nor cash flows. And cash flows are important when you're the lender to the business. We also don't do distressed. And I think many people don't understand this, but in order to do distressed successfully, you need a team of 20 plus lawyers. And that we are just not set up to do distressed debt investing. We also exclude companies based on the issuance size. And the reason for that is that we want liquidity. So if we want to change our minds about credit, we want to be able to go into the market and sell it. And so we don't do small illiquid credits. And as you can see on the slide here, we exclude anything with a bond issuance size of $250 million or below. And then we also exclude companies for ESG reasons as well. So that basically means that we think 46% of the global high yield market and 35% of the investment grade market is uninvestable. Now that puts us apart from most other bond fund managers, in my opinion, who will buy a basket of companies and sectors from across the market. We are much more, we've got a specific style of investing, which I think is much more similar to some of the equity fund managers that you'll see. So we'll go to the next slide. So I'll give you a bit of an update on what has happened to credit this year. Mm-hmm. So all the action, if you look at the right-hand table, has really been in the CCC part of the market, which has seen returns of 8.9% on the year. And in particular, triple C energy, which makes up 0.9% of the market, has delivered an equity-like 49.7% return on the year. Spreads were quite tight when we put the slide together, so this dated 31st of October. We then had the Omicron news that came, and what happened there was that credit moved out on the back of that news towards the end of November and into early December, but has quickly snapped back since then, in particular in the US. And in our mind, credit doesn't stay cheap for long in this type of market. The reason for that, we think, is that it's due to improving company earnings, low defaults, and still good technicals, a good demand for the underlying credit. So I would say 2021 has been a carry market with some spread compression. We go to the next slide, please. So one of the areas of the markets that we like is rising stars. So if you look at the left-hand table there, in the dark blue line, that's upgrades versus downgrades. And if it moves above the line, it's you're seeing positive momentum in ratings. And rising stars describes when a company's ratings get upgraded from BB to BBB, and therefore moves from high yield to investment grade. What tends to happen when the company moves from a high yield into investment grade is that you get forced buying from some of the investment grade accounts. So when you're holding these bonds, not only do you clip the coupon, but you also have some price appreciation. Now, as an example, we bought a company called CrowdStrike, who is a 47 billion market cap company in the US that provides cloud-based security solutions. We think the bonds offer 4 to 5% total return opportunity over the next 18 to 24 months when it gets upgraded to investment grade. Just to give you context, on that 47 billion dollar market cap, so far it's only issued one bond of $750 million. So there is quite a lot of equity cushion underneath this business, and it still offers quite an attractive opportunity in our mind. We'll go to the next slide, please. So in 2021, defaults have been very modest, with 2 or fewer defaults per month for the whole year, if you look at the left-hand table. When we put this chart together, I think the chart now is out of date. So as at the end of November, defaults in the US are running at 0.38% for US high yield and 0.83 for US loans. So very low.
That's incredibly low, isn't it? So is that because the companies are doing okay, or is it because of government support and things for what they're doing?
So it's a mixture of things. I think the companies are doing okay. So you've got better fundamentals. The market opened up very quickly post-COVID, so that people could go in and refinance any upcoming maturities. If we remember back to the great financial crisis, what you saw then was that the market basically shut down or was very slow for 12 to 18 months during that particular crisis. With COVID, the central bank stepped in at the end of March, particularly the Fed, and said, we're going to be buying bonds in the secondary market. And so they were very quickly onto any issues that might creep up. And so that enabled companies to go back and refinance, and also to raise cash to get them through the kind of COVID difficulties. And also what you've seen is, I think there's just been a move in terms of better quality companies coming into the market. So there's been a greater proportion of BBs and a smaller proportion of CCCs. And just to illustrate this further, James, is that JP Morgan, when they're forecasting US high yield default rates for the next couple of years, they're forecasting 0.75% in 2022 for the US and 1.25% in 2023. If you look at the chart on the right, you quickly can ascertain that that's, I mean, historic low default rates, even from a historical context.
Yeah, incredible.
Yeah.
What's the sort of lowest credit rating you do invest in?
We'll go all the way down to triple C's, and the reason for that is there's some opportunities there where we think there is an attractive opportunity, and the way we look at businesses is we look at attractive companies who've got good moats, a good pricing power. We rather back a good company with a good management team, and then we look at ratings after that, then start with the rating and then work backwards from there. So we, what we're trying to basically find are these kind of high quality franchises that we can put into the portfolio and then invest in those.
Cool.
So
okay.
To move on a bit to the macro picture.
Yep.
On the next chart. This is one of the inputs we use to think about our optimal asset allocation for this fund. We also use it to manage duration for other funds in our fund range. This is more of a credit fund, but we use it for asset allocation purposes. So you've got the bond yield in blue against the year-over-year rate of change of economic data in gold. And the way we compute this, so we do it on the desk, we use 33 different inputs of growth and inflation. And the gold line shows whether that data is accelerating or decelerating and what the pace of acceleration is. This is the second derivative of growth and inflation, but this gives us quite good insight in terms of what the market's thinking. So the market, when it looks at, doesn't look at the levels, but it looks at whether that is the data is improving or getting worse, and then forms a view in terms of what is optimal asset allocation. So coming into 2021, we saw the orange line here really picking up, and there were three particular catalysts in the US for that. One was the fiscal stimulus, so the packages that Biden was able to pass through. Second was reopenings in the US, and the third was the rollout of the vaccines. What we then saw was that the data started collapsing into the summer, and that was driven by the fact that the US reopened in the summer of 2020, and so there were difficult base effects to compare against. And when you look at this data now, it's pointing downwards into 2022. So basically, the peak, the catalyst that we saw in the spring of 2021 means that the base effects are going to be very difficult to comp against, and that's quite an interesting narrative. Go to the next slide. This is basically showing the 530s curve, and it's showing a flattening of the curve, which is quite important. And the bond market is basically sending a very powerful message. And this dates back to the June FOMC meeting, when the Fed began to go hawkish. The curve started to flatten. And the scale of the flattening so early in the cycle was a powerful statement from the bond market in our view. And basically it's saying that when the Fed is going hawkish, it can't get too many hikes in before slowing the economy. And basically at the moment, the market's predicting 2.5 rate hikes in 2022. But you see here that the market is, the bond market is basically saying that this kind of recovery, you're not going to see that many rate hikes before the economy really slows.
Yeah, exactly. Just to explain, because somebody's asked the question. So what we're looking at here is the difference in the yields between the 5-year Treasury and the 30-year Treasury, isn't it?
That's right.
At the end, we've got about sort of, I guess it's trying to read the graph here, about sort of 75.75% between the yield on the 5 and the yield on the 30.
That's right.
So, yeah, cool.
And that's quite low, and that tells you that the bond market thinks this cycle is quite mature already. So if we go to the next slide, and I'm speaking now without the benefit of the CPI print that's coming at 1:30 this afternoon, but this is inflation, and it's been on everybody's mind, and we think the next few months will be tricky. The inflation we're seeing at the moment is really a tax on the poor, and there's been a lot of political pressure put on the Fed to act. So they've been stopped out of this transitory narrative. Jerome Powell said transitory has been removed from his statements, and what you're seeing now is that the Fed are scaling back the QE purchases, and also they're starting to think about rate hikes. What will be interesting is when the Fed meets in mid-December is whether they increase the scale back of QE purchases. Currently, they're scaling back at 15 billion per month, and there's a thought in the market that that might be increased to 30 billion per month to give them flexibility to raise rates when the QE purchases have been finished. This forecast is from Alan Detmaster of UBS, but he's basically showing that headline CPI will rise to about 7% by early next year, and core CPI will move up to roughly 6%. This is kind of the final hurrah of inflation, and in his mind, he thinks that core CPI at the end of 2022 will finish at 2%, and headline CPI will finish at 1.5%. Now, remember, inflation is a 12-month rolling average number. So some of these kind of high prints this year, even if we're running at an higher level in 2022, because of the high numbers as we're seeing in 2021, that will be masked somewhat in 2022. We might still see some high prints, but because of the abnormally high prints that we've seen in 2021, be difficult to to work out the underlying trend. But in our minds, a lot of the inflation that we've seen is somewhat transitory, such as supply bottlenecks, chip shortages spring to mind, and difficult container ships circling around outside of Los Angeles port. These are things I think the market will take care of itself. Some of the other parts of inflation, the more core parts, such as wage inflation, that will, and owners equivalent rent, there is a bit of firmness in those numbers, but the other parts of the inflation number, like oil, commodities, they will sort themselves out in 2022 in our mind. But the Fed are on the case at the moment. So we'll go to the next page. This is an interesting chart which I thought I'd throw in, but basically it shows what does the 10-year yield do post-recession. And in the first year, you get a rise, and that rise is driven by your comping against the recession or recessionary year. So what you see is easy base effects to meet, and commodity prices increase as demand increases post-recession. And then in the second year, you're comping against those tough and elevated first-year comps. What you see is that the 10-year yield during the second year post-recession tends to retest the post-recession low in terms of yields. So in our mind, 2022 is setting up to be a more fertile environment for bond investors, based on, looking back at history. Mm-hmm. We'll go to the following page, on page 11. So again, this is one thing that's been puzzling the central banks.
Yeah, I think this is the main thing that people go, well, this is why inflation might not be transitory.
Yes. So what happened to the workers post-COVID? In October, the US have had 11 million job openings per the latest JOLTS report that was published this week, and people gain confidence in terms of quitting their jobs. So in October alone, you saw 4.2 million people quit their jobs in the US. That's a very, very, very high number. Go to the following page. What is driving this? And we think there's a number of factors. So if you look at the historic participation rate, you could argue that unemployment's running at a rate of 8%. You look at the adjusted participation rate, so they're making certain adjustments. They think unemployment's running at 4.2%. And this is quite important. So, you know, what is the proper participation rate and where have the workers gone? Because it impacts monetary policy, whether you want to continue running it tight or loose. And I think the Fed are now coming around to the view that they should be running it tight, i.e. participation rates have reduced somewhat. And we go to the following page. This is quite an interesting piece of work by Goldman's. They're trying to quantify what's happened to the workers. And so on the right-hand side, you're seeing in the light green, demographic trends. The US is getting older, and so more people are retiring. In the dark green there, due to the booming stock markets post-COVID, and you know, elevated 401ks, people got the confidence to retire early. Then you've also got pandemic exits. So what this is really, what they're trying to identify here is cautious workers who may have been fearful of COVID and didn't want to be exposed to it, childcare issues and so forth, and they are temporarily out of the market and will take time to coax back into the market. And what's interesting here is that the hawks will argue that unemployment's back to the right level and look to tighten monetary conditions, and the doves will argue, well, there's still some slack in the market and participation will start creeping up. This is one of the key debates going on in the market at the moment. So that gives you a bit of flavor on the macro picture that we're facing at the moment. To summarize, this year for the fund has been all about carry. Fundamentals still support being constructive on credit, but on the margin, we've been upgrading the quality of the portfolio. Inflation concerns are already priced into the market with 2.5 rate rises forecast in the next year. And this fund is all about delivering a sustainable and reliable income to shareholders through holding a mixture of fixed and floating rate bonds. So I think we've managed that this year, and we look forward to doing so in the future.
Cool. Okay, we've got loads of questions. So just one quick one first. Somebody said, what's JOLTS? So it's the Job Openings and Labour Turnover Survey. So it's, as you said before, I think it's a measure really of how many people are quitting their job and going to get new jobs. Is that right?
Exactly. That's right.
Yeah.
Yes.
Okay. Good. Right. How should we start this? I think first of all, let's talk a bit about the team, if you don't mind. So who else is working with you on the team, and what sort of resources have you got?
Okay. So we this fund is headed by Jenna Bernard and John Patillo, and I work with them. I'm a fund manager on another income vehicle that we run within the team. We've also got a senior analyst that's recently joined called Oliver Bardot. He joined from internally within the team from our loan team. So he's a very experienced credit investor. And then we've got 3 other members of the team as well. Dylan Shah, who's helps with the quantitative work on around the rate of change data. Arjun Bahandri, who helps with the performance data, and then Irim Khan, who we brought on to help with the ESG piece. We're then further supported by analysts both in London and Denver. So we've got 2 offices, and they basically look at both the high yield and investment grade market. There's roughly 25 of them, and they issue recommendations on names. So there is a big team supporting us in this vehicle, and then we've also got a loans team as well, which supports us with loan ideas. So we kept very busy in terms of scouring the market for the best ideas to put into this trust.
Cool. So it's a global fund. What's the sort of geographic allocation look like?
Good question. I'll see where I can get that data. So geographically, we hold roughly high 60s in the US and mid-teens in Europe and the UK. The reason why we go to the US, I would say, is that the US, we tend to find it's a much more mature high yield market there. So you see a lot more companies that are listed are quite comfortable going to the high yield market. They've got huge market caps, they're growth businesses that are coming there. And so this fund is, kind of transitioned and buying more US dollar assets because it basically contains more of the kind of quality companies that we want to invest into.
Yeah, okay, that makes sense. You mentioned about the direct loans. So why has the proportion of those declined over the years, and will they come back again?
So the reason they declined was we felt the market was getting a bit frothy at the time, and we found better opportunities in high yield. At the moment, they have been coming back slowly into the portfolio. I think the market, loans used to be an asset class that had very strong covenants and were almost, slightly better than a high yield bond in terms of the covenants and the control that they had over companies. These days, I think with the advent of covenant light, so basically very few covenants, I think loans and high yield are very similarly rated in terms of quality of asset. And so we are pretty flexible whether we invest in high yield or loans. The loan opportunities that we've seen, loans tend to be the market that are favored by the private equity purchasers, just because they don't have any call protection. So they can basically refinance the deal at any point or any time. Whereas when you go to the high yield market, you have something called call protection. So if you want to refinance a deal, you have to pay a charge, if you like. So instead of refinancing at par in the high yield market, you refinance at 104, 105. So you get a bit of a premium as a holder of the debt when they come and refinance. So yes, so loans have been picking up a little bit in terms of if you got rate rises coming through in the market, then that market should benefit from that because it's a floating rate product which trades off LIBOR. So if LIBOR is moving up, you expect that to do quite well. Okay,
fair enough. I know that there was a bit of turnover when the market fell out of bed last March. Generally, what's the sort of turnover in the portfolio like?
I haven't got the stats to hand, but yes, what we did do was we re-risk the portfolio, if you like. So coming into COVID, we'd been running it quite defensive in terms of buying more IG and buying more defensive credits. COVID happened, and what we decided was this seemed to us to be a very good opportunity to increase the risk. When we got comfortable that around the situation, and also we looked at the rate of change of the data, things weren't deteriorating any further and started stabilizing and in fact improving. We got quite constructive on the market. And the way we increased the credit beat the fund was we used the synthetic gearing. So we added crossover credit to the fund. We also switched out of some of our investment grade holdings and bought the high yield paper into the portfolio to benefit from the rally that we were foreseeing in credit spreads. So we took advantage, basically.
Mm-hmm. And what did that do to the income account? Because there's a question here about is the dividend yield on the fund covered by revenue?
Yes, it is. And we've got a revenue reserve as well, a modest revenue reserve, but it's covered at the moment.
Cool. Okay. You mentioned ESG. There's one sort of final thing on your screen.
Yes.
Is that something that's sort of typical in your market, that people have an ESG screen?
I think it's becoming more accepted these days. We approach it from a slightly different, our angle is this, that we've always done this kind of quality bond. We've always bought quality bonds and quality loans. So to us, some of the more ESG unfriendly industries were naturally screened out from the get-go. So things like energy, airlines that don't do very well on an ESG screen. But when we run this portfolio against an ESG, against the different third-party ESG providers, it comes up very strong in terms of its profile. I'm not sure whether I think it's something that we've published in our annual report, so you can refer to that. But this fund, due to that quality bond filter, does screen very well from an ESG perspective, just because of the companies that we're putting into the portfolio. And then we've got, a further screen as well, which is we don't invest in companies that are in countries that are not free. So on a Freedom House index, so countries such as where there's no free elections, or they commit atrocities against people within the country, we won't invest in those.
That probably is another way of adding quality to the portfolio, isn't it?
Correct. Yes.
Yeah. Asset-backed securities, ABS. There's a question here. So are there any in the portfolio, and would you invest in them?
They aren't in the portfolio, and we have just shied away from them in terms of this is a very liquid portfolio, and there are times when that market, I think, just becomes a little bit illiquid. So there are fewer participants in the market, and we just haven't, we decided that it's not a market for us and for this vehicle.
What about issues from banks and other financial companies? Do you buy bank capital?
Oh yes. So it's something that we've been quite constructive on for a number of years. So I mean, if we think back to the previous financial crisis back in 2007 to 9, it was basically the banks that were one of the bad guys. And following that crisis, the regulators and authorities put a number of restrictions in place on banks. So they had to raise more capital, they had to de-lever the balance sheet, this made them much more investable and quite an attractive prospect. And so we do hold a good smattering of financials in this vehicle.
Okay, good. There's actually quite a good question here. So how much of your time is spent thinking about the kind of macroeconomic picture, and how much is actually looking at individual bond issues?
So the way, I mean, we kind of, the more macro stuff tends to be done by Jenna and John. We'll talk about it, we'll have morning meetings, discuss what's been going on. Myself and Oliver Bardo tend to focus more on the credit side of, and liaise with the analysts across the company and find the right opportunities to put in. So, we do split out the tasks, and John and Jenna will be involved in, picking some of the credits as well, and, setting a style in terms of asset allocation.
Okay. One question, just thinking about next year. So there's been sort of a few heavy hints that they're thinking about bringing an end to quantitative easing and actually unwinding some of the bond holdings on the Federal Reserve balance sheet. What do you think that would do to the market? So
basically what they're doing is they're tightening financial conditions. So they are making them less loose. I think that's already, the central banks these days are acting almost like, they're spoon feeding the market with information. They don't want to surprise the market. They don't want to go, it used to be back in the day that central banks could, change policy at the next meeting. These days, it's much more, they guide the market very carefully about what they are going to do. So I think, in my mind, it's already in the price, this kind of tightening of financial conditions, but it does make it, makes it, you have to be fairly compensated for the credits that you hold. And, the fact that they're stepping away from buying as many bonds means that, conditions will tighten somewhat. But I do think that's already in the price. And you're being fairly compensated in terms of high yield spreads or what you're getting.
In terms of the exposures that the portfolio has, if we have sort of another, we all did, some markets already seeing another round of lockdowns and impact on travel businesses and leisure and that sort of thing, does that going to affect the portfolio?
I mean, the fund actually did incredibly well through COVID. So we compared it. So we didn't have huge exposure to the travel, leisure, and gaming sector. I think it was roughly 4.5% of the fund had that kind of exposure. We've managed that very well through 2020, 21. We do have some exposure to gaming in the US, and then we've also got a holiday park operator in the UK. But I think looking at what they're talking about in terms of restrictions, people are still going to be able to travel within the UK, and I think the US, in terms of how they're responding to COVID, is going to be very different to, for example, how Europe's responding to COVID. In the US, I think they are not talking about lockdowns; they're just talking about vaccinations. Whereas in Europe, on the other hand, they're talking about locking down people, and so we feel quite comfortable with overall exposure. So we don't have exposures to stuff like airlines, which is clearly going to be impacted, in cruise industries, which clearly is going to be impacted because the type of passengers that go on cruises are older, and they're going to be a bit more cautious about whether to travel on one of the on Carnival cruises and go on a three-week cruise around the Caribbean with 600-700 other people.
Yeah, probably right. So given that, then, what do you think the biggest risks to the portfolio are now?
I think the biggest risks to the portfolio. I'm just trying to think.
Well, what if inflation was higher and more persistent than you thought? Would that be a problem?
So because it's we do hold quite a lot of high yield in the portfolio. High yield actually tends to do quite well with inflation. It's a lower duration asset class, but you also see earnings increasing due to inflation, right? So you get the benefit of, you still have the same amount of debt, but your earnings are going up, and so as a, you know, okay, the numerator denominator means that you'll see deleveraging. So I'm quite comfortable with you know, that kind of risk. And I also think what the central banks are telegraphing is that they will be raising rates to try and stem, you know, what has looked like transitory but could be a bit more semi-permanent inflation, and they'll be doing that in 2022. I'm trying to think of what else. What are the big risks? I mean, I'm still in the view that, you know, you've got low defaults, you've got decent company fundamentals. We did chip out companies that we didn't feel were able to pass through these kind of inflationary commodity increases to the end customer. So we've already done that to the portfolio, which is quite, you know, heavily, you know, we do manage it very carefully. So I'm not seeing anything at the moment that particularly concerns me, I have to say.
Cool. Okay, that's good. That's probably a good place to round it up. But so thank you very much for that, Nicholas. It's really interesting. I think it's sort of, it plays on so many different themes that go on in the market, for equity investors as well as bond investors. So really quite useful.
Thank you for having me.
Thank you. If we just have a look at what's coming up, then please. To wake up our slide mover. There we go. So we are now going to be on our Christmas break for a few weeks, and we'll be back talking to you again on the 7th of January, hopefully with all the systems working properly. And I will be doing a roundup of 2021 with Andrew and Hattie, which is something we did last year. So we looked at all of the movers and shakers of the year. 14th of January, we think we've got somebody fun lined up, but we'll have to get that confirmed and then come back to you. Then we've got Franco, the manager of CQS New City High Yield, and then SDCL Energy Efficiency, which is, I think, a really interesting fund. I think we've talked to them before, but I think we'll get an update on that. And then probably back talking about inflation again for a while. Sebastian Lyon is going to be here talking from personal assets. So he will have some views, I think, too, and we'll see where we are on the 4th of February. So if we don't see you any other place, have a really good Christmas break, and we will see you on the 7th of January. Thanks very much. Bye-bye. Oh, man.